Hey everybody, Ryan and Matt here with Duckett Ladd Dental CPAs. Today we're going to talk about estimates, quarterly estimates that the IRS requires you to make, what their requirements are, and then kind of how we at Duckett Ladd treat those estimates and how we look at those. So, Matt, why don't you kick us off talking about what the IRS requires as far as safe harbor?
Yeah, sure thing. So the first thing to understand is that safe harbor concept. So the IRS requires you to pay in at least 110% of last year's tax. If your tax was over 150,000, which pertains to a lot of our clients, if your tax was under 150,000, it's just 100% of last year's tax. So by paying that amount in by the required time, you avoid underpayment penalties. So notice I said last year's tax and not this year's income, and that's really the key there. You don't have to perfectly predict 2026. That's pretty impossible this early in the game. You just have to pay in enough based on 2025 to stay protected. So for dentists whose income can fluctuate with things like, production expansions, associate changes, etc., Safe Harbor gives you that stability. It's pretty much our baseline strategy when it comes to estimated tax.
Yeah, that's a great point. So, we're just trying to avoid underpayment penalties at this point for Q1 and Q2. We're going to base that off of prior year's tax. And then mid-year, Matt, kind of what do we do with our clients to make sure they're not overpaying or underpaying from that point on?
So yeah, safe harbor is a great approach for quarter one and quarter two, especially just to stay protected. And then we usually reassess mid-year once we have some real concrete data. So by the summer, we can see key trends or key events that have occurred, such as production. Is it up? Is it down? Did you buy some equipment? Is that eligible for bonus depreciation? Has your payroll increased or decreased for any reason? And how does the practice look overall, and what is it on pace for? So instead of overpaying early and giving the IRS what will be basically an interest-free loan, we try to adjust using that information for quarter three and quarter four. And I always like to say that mid-year tax planning meeting is kind of where the magic happens. That's where we can layer in scenarios and run the traps on things. So retirement plan contributions, compensation adjustments, major purchases, or really anything else we can kind of plug and play. We really think that estimated taxes shouldn't be reactive. They should kind of connect to the overall strategy.
Yeah, those are great points. Now sometimes there could be a really unusual event in your tax year. Maybe it's the year you sell a practice or something like that, where you have a big one-time pop of income. Maybe that's not toward the end of the year. What type of circumstances or does the IRS allow you to do it in something like that?
Yeah, so sometimes safe harbor just doesn't make sense based on key things that could happen or big one-time pops, and that standard divide by four method could end up hurting you either by overpayment or underpayment. So if income's uneven, and that can be common in dentistry, like you mentioned, we can use what's called an annualized income method. So basically recognizing the tax incurred when the income is earned, and again allows you to align your estimated payments with the income. So if you sell a practice or a location, if you have a large one-time equipment write-off, maybe you bought into a partnership or bought a dental practice, big one-time bonuses that you have to hand out. We always think that instead of overpaying early or getting penalized later, the annualized installment method can work in those cases.
Great. So here as we're wrapping this up, Matt, what are some of the biggest mistakes that dentists could make with their estimates?
I think number one is treating them like a surprise. I mean, dentists can be high earners once practices are really chugging along, and there's going to be some tax due if you don't plan for it. So, if you're only thinking about taxes when your CPA emails you in March, you're looking backwards, and the real tax savings that you could have had, real strategies that you could have employed, occurred during 2025. So we don't think as estimated payments as compliance. They're more like checkpoints. And if you're missing those checkpoints, you're probably also missing opportunities.
Yeah, that's great. What about saving for tax? Would it be beneficial for them to kind of put some money away?
Yeah, absolutely. We always encourage a monthly tax escrow for our clients in an upper tax bracket. And that can really help with that, April tax bill not being a surprise, kind of putting that money away month after month during the year.
Yeah, if you can stay on top of things throughout the year, always going to limit the surprises. You're going to have the money there when those quarterlies are due. So hopefully you guys found that information practical and helpful. Thanks, Matt, for giving us all those tips.
Thanks, Ryan.